Good afternoon. I'm Patrick Armstrong, Chief Investment Officer of Plurimi Wealth, and it's the 10th of November 2022. So it's been 1 month since my last update where we talked about oversold conditions, investor pessimism, and the S&P is up 9% since then. And I'm actually not less bullish on equities than I was a month ago. I'm not even much more bullish now because the price is higher. But the fundamental backdrop of inflation slowing today, it's a CPI print today, and year-on-year inflation in the United States came in at 7.7%, which was a little bit lower than expected, which probably sets the course for the Fed to only hike 50 basis points in December and probably slow down to 25 basis points a couple more times early next year. And I think that's probably all we're going to get from the Fed. And the biggest risk for equities at this point, probably not the Fed, not multiple compression, but one pocket of probably exuberance still is from earnings estimates from the consensus that the S&P 500 has a lot of optimism priced into its earning potential next year. And this year, the profit margin for the S&P 500 will be 11.7%. And next year, analysts are forecasting that to rise to 13%. And I don't think there's any way that's going to be achieved. We're in an era where input costs are still going up. We're in an era where consumer spending is going to be curtailed because of higher staple spending, utility spending, petrol prices. All of those things are going to curtail discretionary spending. And I don't think companies are going to be able to pass on all of the higher costs to consumers. Therefore, probably a margin squeeze is what's going to happen. And with this as a backdrop, I really think you want to focus on companies that have defendable profit margins, companies where input prices aren't going to destroy the profit margin as well. So for me, the areas you want to look at for the Q4 reporting season and the first couple of quarters of next year, luxury goods companies, we own LVMH, Hermes, Montclair. Energy companies, they're the companies that are creating margin squeezes elsewhere. They're all cheap, paying big dividends, buying back shares. Healthcare companies, input prices don't matter too much. And companies like Novo Nordisk is a big weight in our portfolios. Obesity and diabetes is the new pandemic in the United States. So companies that have pricing power with good or drugs also will weather this kind of storm very well on a margin squeeze. And finally, agribusiness equities, drought, floods, climate change, global warming, all of that's destroying yield per acre. And farmers are going to have to plant more land. Every area of arable acres is probably going to be planted. More demand for pesticides, fertilizers, farming equipment. Those kind of companies, I think, are set to meet and beat earnings estimates next year. And that's where I'd position an equity portfolio after the 9% rally we've had for the last 4 weeks. So I'll leave you to ponder that, and that's it for today. Good luck.